Margin trading means borrowing money from your broker to trade with more than you have. It sounds like a shortcut to bigger profits, and it can be for experienced traders who understand and respect the risks. But for beginners, margin is the fastest path to blowing up an account. In this video, I am going to explain exactly how margin works, what a margin call means, and why you should probably avoid it until you are consistently profitable without it. Margin trading lets you control a position larger than your account balance. If you have $10,000 and your broker offers 2-to-1 margin, you can buy $20,000 worth of stock. The extra $10,000 is a loan from your broker. This leverage amplifies your gains. A 10% rise on a 20,000 position is $2,000, which is a 20% return on your 10,000 account. But it equally amplifies your losses. A 10% drop is also $2,000, which is a 20% loss on your account. And it gets worse. At higher leverage ratios, the math becomes catastrophic. The amplification effect of margin works both ways. When it goes right with 2-to-1 margin, a 10% gain on the underlying position becomes a 20% return on your capital. Your gains are doubled. When it goes wrong, a 10% loss on the position becomes a 20% loss on your capital. Your losses are doubled. And at a 50% loss on the underlying position, your entire $10,000 account is completely wiped out. The borrowed money must still be repaid. At that point, the broker issues a margin call. A margin call is the most feared event in trading. It occurs when your losses reduce your account equity below the broker's minimum maintenance requirement, typically 25 to 30% of the total position value. When this happens, the broker demands that you immediately deposit more money to bring your account back above the minimum. If you cannot deposit the required funds, the broker will forcefully liquidate your positions at whatever the current market price happens to be. You have no choice. No room for negotiation. No option to wait for a price recovery. Your positions are closed at the worst possible time, locking in the maximum loss. Margin calls have ended more trading careers than any other single event in trading. If you do decide to use margin, 5 non-negotiable rules. Never use the maximum available margin. Keep your margin utilization under 50% at all times. Always use stop losses. Define your maximum acceptable loss before entering any leveraged position. Understand the interest cost. Margin is a loan from your broker that charges daily interest on the borrowed amount. This cost adds up, especially on positions held for weeks or months. Never hold leveraged positions overnight unless it is a deliberate, planned part of your strategy. Overnight gaps can trigger margin calls before the market even opens. And the most important rule, beginners should avoid margin entirely. Learn to trade profitably using only the cash in your account first. Here is the bottom line. Margin is a tool designed for experienced traders who already have a proven, profitable strategy and want to amplify their returns. It is a trap for beginners because it amplifies losses at exactly the stage where you are making the most mistakes. Using leverage before you can profit consistently without it only accelerates how fast you lose your money. If you cannot make money trading with cash, margin will not fix the problem. It will make it worse, faster.